For 10 years, this company yielded above 1.5%. Quality compounder, always looked expensive, never went on sale. Right now, it yields around 4.6%. When a stock does that, one of two things is true: the dividend is about to stop growing, or the market is wrong about the business. Free cash flow covers this dividend three times over, so it is not the dividend. The company is Accenture, has 20 years of raises, 51% off of its high. I bought it in July and I'm buying more this month. Here is the math I ran. So today's show is going to be this dividend monster is dirt cheap and I'm buying. I'm still buying. So this company has an overall forward yield of 4.6%. It's been paying a dividend for 20 years. It's roughly was off its highs of 51%, and it was trailing at 10.7 times earnings. So the company is Accenture. So if you are not familiar with this company, we are going to kind of dig into it here for a little bit. So I did a write up on the company that's behind a paywall, and today I'm going to be revealing some of the information that was behind the paywall for Accenture. So this was a falling stock and a growing business. I wrote about this in July, and so some of these numbers are from the July write up, but the analysis and the thesis still stand. And even though the company I wrote about it in July 7th, it was trading at $142 at the time, which was 51% off its 52-week high of $291. It's now trading around $188. So the market realized that it had mispriced the company and it had jumped up quite a bit. So if we look at the business, we can see that the fiscal 2025 revenue was up 7% for 60, almost $70 billion. Their guidance for 2026 was up 10 to 11% for earnings. And their free cash flow guidance, which is something we're very interested in, was for 10.8 to 11.5 billion, and the dividend raise was 10%. So when we look at the company here, we can see that this is a very, very strong business. Okay, so what we're going to cover today, we're going to look at four different parts of the business. So we're going to look at the business, so what Accenture actually sells and where the moat is, real or not. We're also going to talk about the dividend, the raise streak, the growth, and the safety, of course. We're going to discuss valuation and why I think the company is cheap and why I still think it's cheap, and obviously my verdict and what my buy below price is, position sizing, and anything I'm looking at to see if the thesis is broken. So, what does Accenture do? A lot of you may have heard of the company, maybe you've heard people talk about it, but don't know exactly what it is. So, Accenture installs, integrates, and runs technology for the world's largest companies. So, think about the hyperscalers, for example, use Accenture to help integrate AI into enterprises. So, AWS, Google, Microsoft, Azure, all these companies are using Accenture to help them integrate their AI stuff into companies. So, for example, when a Fortune 500 CEO needs SAP migrated, a cloud stood up, or an AI rolled out across 80,000 employees, this is who they call. So, as we mentioned earlier, they did almost 70 billion in revenue in 2025, which is up 7%. They have almost 800,000 employees. They have over 9,000 clients, and they have 37 billion contract future work, which is very, very important. So basically, they rent out the world's largest bench of enterprise technologists, the 800,000 people that they employ, and they convert one-off projects into multi-year contracts to run what they just built. So it sounds complicated, but it's actually not that complicated. So the company has two engines, but it has kind of one flywheel. So they split the business into two main groups. We have the consulting group and we have the managed services. So the consulting group was what most people are familiar with, and this is the advice and build work. They projects based. They re-win deal by deal, and they compete with Deloitte, IBM, TCS, and Infosys. And so that contributes about 9.3 billion to the top line of the company. Managed services is the other flywheel, and this is the operations contracts, multi-year, recurring, sticky. This is the part that includes all the AI that they're working with. And this is where most of the moat lives, and it's also growing the fastest. So it grew 8% year over year, and compared to the consulting, which is only growing around 4%. So the consulting is the air quote more legacy part of the business, where the managed services is the part that the company is actually pivoting towards and is pushing more towards growing the business. So this is very important. The company does have a moat. It's narrow, but it does have a moat, and it's a little bit even. And so let's talk about the good and the bad. So the good, switching costs. So they have switching costs in their managed services. So think about this: when a company like a bank, BBVA, for example, recently had to integrate all of their technology, their online services into an app. And what they did was they used Accenture to help pull out all the plumbing and rebuild all of it. And so if you've ever worked at a bank, you understand that technology there generally is kind of archaic and it's a little bit behind the times. And so to pull all that out and put new plumbing in is not an easy thing to do. So you have to have somebody that's qualified and knows their stuff. Number two, you have to have somebody that can help train all the employees to use the new tech. And number three, you have to have somebody that can manage it once it's up and running, because a lot of times the bank in particular, they don't want to spend the money to it's cheaper for them to spend the money having Accenture manage it than hiring people, training them, and having them do it internally. Doesn't mean that banks don't have internal tech; they certainly do. But in this particular circumstance, that's where Accenture shines, and that's one of the parts that is really, really hard once you have Accenture install that plumbing to pull it all out to go with somebody else. So they have 37 billion in contracted backlog, which is up 19% a year. This is something that we want to watch very closely, because this tells us how much future work the company is having and how successful they are in renewing any one-year contracts that they have. And they have a scale that nobody can match. They're huge. 800,000 employees is quite large. So they have a large bench, they have training engines, and they have partnerships with, as I said, Microsoft, AWS, Google Cloud, and ServiceNow. So where is this kind of weak? So consulting is deal by deal. And so they're also competing against very strong competitors in Deloitte, IBM, TCS, and Infosys. So just because they have a contract doesn't mean the next contract is guaranteed. So that makes it a very, very competitive, long process. There's no network effects. There's no low cost advantage. It's an average brand. So most of the classic wide moats that we assign to a lot of companies, like a Visa and Mastercard, for example, they aren't present here. And the company has little to no pricing power. So the gross margins have been fairly flat over the last 5 years at around 32%, which is not horrible, but it doesn't indicate much of a moat. So however, the how strong or not strong the moat is, and although the revenue growth is not, Google like, 7% is nothing to sneeze at for a company this size and what they do. What we really like is the profitability of the business, and this is unquestionably an extremely profitable business. So it's a very much an asset light business. So almost every dollar of the profit that they generate from their revenue shows up as spendable cash, and there's no debt pile competing with shareholders for it. So for example, the company generated 10.9 billion in free cash flow. The conversion from net income to free cash flow is 140% plus. That is ridiculous. They have 5 billion in net cash, which means they have more cash on the balance sheet than they do in debt. And their interest coverage is 45 times, which means that they can pay for their any debt payments that they have, but 45 times over that. So this is an extremely, extremely profitable business. And so, as it says here in the slides, earnings are an opinion, but cash is a fact. And so, the fact that this company can generate that much cash from the revenue that they're generating, that is extremely, extremely amazing. So, that is something we definitely, definitely love about this business. So the dividend. So this is why we're all here, right? It's not because of the flashy stock price and what kind of appreciation we can get from that. It's what kind of capital return are we going to get for the stock. And so the dividend has never been this low. This is one of the companies that has always been air quote a quality compounder and has always traded at an elevated multiple for many, many years. and it's always been on a wish list of companies that people would want to own if they ever had the opportunity. Well, guess what? We have and had the opportunity. So the dividend yield for a long time was 1.5% or so. Right now, it's paying an annualized dividend around $6.50, and they raised it for 10% in November of 2025. The forward yield right now is 4.6%, and the trailing yield is 4.2% at $142. That's probably changed. I frankly didn't check that before coming on. I should have, but it would be lower. As the price goes up, the yield's going to go down. So that is something to keep in mind. So the stock has yielded 1 to 2% for a decade, now pays 4.5%. That happens for one of two reasons. The market is wrong about the business, or the dividend is about to stop growing. As we just saw about the profitability, the dividend is not going to stop growing. So the reason why this yield popped up so much is because the market was wrong about. I feel like the market was wrong about the business, and it looks like the market agreed with me because it has rebounded quite nicely since I wrote this up. So the history of the dividend, it's had roughly 20 years of dividend raises, so that's awesome. And if you look at the compounding growth of the dividend from the last 10 years, all double digits, 10 to 13% over the last 10 years. That's outstanding. So this is a company that has a lot of profitability and is committed to paying a growing dividend, which is something we definitely like. So this is a great dividend payer. So if we look at the dividend safety, this is obviously very important. We want to make sure that if we invest our hard-earned money in Accenture, they're going to keep paying us its dividend, right? So if we look at the dividend math kind of quickly, if you look at the payout ratio on earnings, I like to look at them in two different ways. One is earnings, the other one is free cash flow. So most screeners, including some of my favorites, Fiscal.ai and Stock Simplifier, both use earnings, but free cash flow is really where the rubber meets the road. So if you look at the payout ratio for GAAP earnings over the last 5 or 6 years, it's hovered in the high 30s to mid 40s ish or so. The one that I trust the most is the free cash flow, and that's hovering around 34%. So the company paid 3.7 billion in dividends against 10.9 of free cash flow. So nearly every $3 of free cash flow is paid out in a dividend. So the forward free cash flow payout ratio is estimated at 36%. So the safety verdict. So think about this. If free cash flow fell 50% tomorrow, so if it fell from 10.9 to around 5%, 5 billion, the dividend will still be covered with room to spare. So that's about as safe as you can get for a 4.6 at the time yield. So that is outstanding. And those are very strong numbers. So where am I getting all this number stuff? So Stock Simplifier is the tool that I use. So every financial figure in this deep dive came from Stock Simplifier. This is the research tool I use for all my dividend school work. Right now, you can get 5 years. This is on the free plan. You can get 5 years of financial data for every stock, income, revenues, all that kinds of stuff. You can also analyze the dividend safety, which is very important for dividend investors. So you can look at the analysis on every dividend payer, and you can also look at valuation data. You can find all this at app.stocksimplifier.com, and you'll be able to find that really easily. All right, so what let's look at some honest numbers. So the growth of the company, as I mentioned earlier, is not going to light the world on fire. If we look at the last 5 years, it is skewed drastically because of the pandemic. If we look at the 2021 period, you see what was that 21.9%. That's obviously ridiculous. Then it dropped to 4.1, then 1.2, and then the last couple of years it's been around 7%. So the when you're trying to estimate this company's growth to look at the valuation, it's a little tricky because we have such wild numbers. You have many ways that you can approach that. You can average them, which is going to give you a higher number because that 21.9 is going to skew the number higher, whereas the 1.2 is going to drag it down. So that's going to be kind of eh. The 3 year CAGR is 4.2%, but again, that's kind of skewed by that really negative, really low number of 1.2%. You could look at the 7%, 7.4 4%. The way that I like to do it, and we'll talk about this in evaluation, is to look at a range of numbers and try to determine whether we think which one of these is more probable or possible. So when we look at that, you have to be honest about the numbers, and the pandemic has skewed a lot of the averaging or trying to use the median over the last 5 or 6 years. So some forward indicators say that the company's pivot to land and expand is working. So they have 3.7 billion in remaining performance obligations or contracts. They have 22.1 in record bookings, a book to bill. This is a very, very key metric to look for when you're analyzing a company like Accenture. Basically, what you're wanting to look at is you want to see what the record bookings are compared to the revenue that they're generating. And so the higher the number, the better. And so anything over 1 is ideal. Uh, the company generated 5.9 in Gen AI bookings in fiscal 2025 with over 6,000 projects. And the company stated in their last earnings call that they are targeting doubling that again. They have $3.3 billion in acquisitions in the last 9 months. This is part of how they spend their free cash flow. As we mentioned, they had 34% payout ratio for the dividend. So they still have a lot of money that they can utilize for reinvesting in the business as well as acquiring bolt-ons to help make the company a better business. So, the company, one thing I will mention about management. So, listening to some latest earnings calls compared to some during the pandemic period, they were going hard and heavy into the metaverse. Remember all that? During that crazy period, they were going super, super into Web3 and metaverse, and that was going to be the next focus of the business. And they went hard into that for several years. So Julie Sweet, who was the is the CEO now, was also the CEO. She took over in 2019. And I think this illustrates something that I really like about the business that I don't think gets discussed a lot is even though they pivoted hard into something like the metaverse or Web3 and all those things which didn't pan out, they have since pivoted hard into Gen AI and embracing AI as part of their business and helping them improve their business and the offerings that they offer to customers. And to me, for a company this large to be able to pivot that quickly shows that they have a flexibility of mind to change their mind and to be able to be uh, I guess, resilient enough to understand that tech is going to change and it's going to move fast, and they're agile enough to be able to pivot and move that quickly. And I think that speaks well of the management as well as their flexibility of thinking and being able to understand that, hey, I'm wrong, and moving on to a new thing that's going to benefit the business as well as shareholders. So that's just another, I guess, feather in the cap of why I like the business. So I mentioned earlier the acquisitions and the cash. So where does the money go? So of the 10.9 billion, the company spent 5.2 billion in. I'm sorry. Yeah, they purchased 5.2 million in acquisitions. They reduced the share count, and they are buying back shares. Some of that is to offset stock-based compensation. So that is something that we definitely need to keep an eye on. They are a tech company. They have to hire the best talent. That is part of the nature of that business, and that's how you attract tech talent is by offering stock in the company. So it is something to keep in mind when we're looking at the business. But they still are able to cover all of these things quite easily and to continue paying a growing dividend. So they are they are growing the dividend. They are buying back stock, and they are making acquisitions when they are prudent for the business. So those are all things to keep in mind, and that's these are all capital allocation is job number one for a CEO. And so when you're looking at any management team, you want to assess how efficiently and how effectively are they allocating the cash. So let's talk. Not everything is always going to be hunky dory, right? So let's talk about the bear case. So these are the 5 things that I think could go wrong with the company. So AI could hollow out the labor arbitrage model. So AI is definitely having an impact on the business, and this is why the market was punishing the company and probably will continue to make it a very volatile business, is because of how AI is being handled and what's going to happen. There are some large enterprises that have employed internally their tech teams using AI to build projects that Accenture would have done in the past. And so those are contracts that Accenture is not going to be able to get, and that's going to have an impact. And that's why we want to watch that book to bill over the long period, because that's going to indicate to us whether the company is able to stay in front and use AI to continue to help them grow the business. So the growth could stall when the payout ratio climbs. So we also want to watch the payout ratio. That's something that we look at every quarter when we screen for the company. The government drag spends. Government is a large part of Accenture's business model. And so you remember Doge a few years ago? Well, that had an impact on Accenture. As the government cut back on spending, that flowed back into Accenture. So that's something to keep in mind on. Pricing pressure from cheaper rivals. There's always going to be competition. We mentioned Deloitte, Infosys, IBM, and TCYC. Uh, I butchered that one. I know I did. But those companies, they're definitely going to have an impact on that. And acquisition indigestion. So, as a moderately acquisitive company, they're gonna make boo boos, and so the hope is that they don't allocate too much capital into a acquisition that uh, impacts the business going forward and impacts their free cash flow. So let's talk about valuation. Why do I think this company is dirt cheap? So there are three basic lenses that I like to use when I'm looking at evaluation. The first is looking at free cash flow. So price to free cash flow yield, any sort of metric related to free cash flow is one. The second one would be a DCF. And the third one for this kind of business would be a reverse DCF. And that's what I use as a sanity check. So if we're looking at a company that it was a REIT, for example, I would switch out the DCF for a dividend discount model. So if I was looking at a company like Johnson and Johnson or maybe Realty Income, I would use a dividend discount model. But for Accenture, we're going to use those three methods. And the reason why I do this is because it's helpful to have benchmarks. It's also helpful to look at what the market thinks as opposed to what you think. And it's also good to have multiple inputs to give you a well-rounded view of what you think the company is. And always remember, valuation is not, it's part science, it's part art. And so the science is the math, the art is the inputs that you put into the math. And so you are never going to get a final answer that is exactly 100% right. A lot of it is guesswork. So there's no blunt way to get around that. It is guesswork. So when we're looking at lens number one, the multiples, we can see here that today, or when I was analyzing the company in July, the company was trading at very, very low multiples compared to its average. So a 15% free cash flow yield for a company like this is kind of ridiculous. And for it to be trading at that low of multiples for that period of time was, for a business of this quality, I think was, there was definitely a dislocation in price. And so that was one screen, if you will, to tell me that I think this company is kind of dirt cheap. Lens two and lens three, as I mentioned, is the DCF and the uh, reverse DCF. So if we look at DCF, which is valuing the free cash flow the company generates, looking at trying to estimate how much that's going to grow into the future, and then discounting it back to the present, and trying to find out what that money is worth now compared to what it would be worth in 10 years. So if you look at a 10-year DCF, built off a trailing free cash flow of 12.5 billion and using a discount rate of 9.5% based on the company's weighted average cost of capital, or WACC, and using a terminal rate of 3.5%, which is kind of a hedge between what the treasury is right now versus what the GDP of the US is growing at. So if we do that, we see that even that the company is generating definitely well above the stated uh, price of $250 or I'm sorry, of $188 at a time. It was $142. And so I thought I was kind of crazy. So even if I adjusted those numbers down, it would still show me a very conservative number of $250 a share. So if I look at the DCF, All right, if I look at the reverse DCF, so what must be true to justify $135? And it's time that it would say that the free cash flow needed to shrink, not grow, shrink 16.2% a year for 7 straight years after growing 8.5% for 3 years. So that to me was a really great sanity check to tell me that, okay, I think the market is being a little bit extreme in the valuation here. And I think they're dislocating the price compared to the quality of the business and maybe how much the AI fears were being overstated with this particular business. And I'm not doing a victory lap because the stock is up 30% since I wrote about this. That's a fluke. I think more realistic is that I think the market realized, hey, there was a dislocation in the price and the company is definitely undervalued and it's a quality business. And I think we need to give the AI fear thing more time to see if it's going to play out or not. So my verdict, I'm still buying. I bought in July. I'm going to buy some more in August. My buy below price calculated then was $188. I would probably move that up to about $220 right now. I feel like this is a very, very, very strong business with a lot of room to grow, pays a great dividend, tons of free cash flow. And the thing I'm going to be watching is going to be that book to bill. I'm going to watch that very closely. I'm also going to watch the second segment, not the consulting segment, the other segment to see how quickly that continues to grow. This is going to be a small position for me because, again, I can't discount the AI fears. So I bought the initial position at 1%. I'll probably add another 1% this next buy. And so that's kind of how I protect myself from the downside in case I'm wrong about what's going on with the business. So, four tripwires that I'm going to continue to watch is the gross margins, the payout ratio to make sure that that continues to stay under 55% for earnings and under 40% for free cash flow, and to see if the company continues to raise the dividend. And if it comes in under 5% this September, I will revisit the thesis at that time. So, what I'm watching on the next call, the bookings to bill, the free cash flow, guidance, the dividend raise, Gen I bookings, and the federal drag. So that is another part of it that I didn't mention there. So those are the things that I'm going to continue to watch. So that is going to, I guess, wrap up our discussion on Accenture. And I will go ahead and switch back over to the conversation part of the